Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over copper inventories. We're going to go over some oil. We're going to go over coal. We're going to go over a bunch of some articles that I've been reading that hopefully give you a little bit more confidence when you go to invest in your investments. This is what sticks in my head, not necessarily the short-term movements, which drives fear into people. You see your account go down, and guys, I'm down a lot in mine from my highs. I'm up a lot from the bottom. I've pulled back good 25, 30% from my highs is where I've pulled back from, about 25% or so. Remember, I'm heavily invested in some of mine, like the energy companies, precious metals, and this is what keeps me driving forward. The big picture, supply demand, inflation, all of those things. So this is some information and data to chew on when deciding how to allocate money. I'm a big believer in the royalty companies. I own Nova Royalty, NOVRF. It's a copper nickel royalty. It's a very small royalty. They don't have any paying royalties at the moment. They're basically going out and getting tier one assets, the big boys, and getting their royalties from, we'll call it private people. So people own royalties. It was their land originally, and what they do is they do a deal with them. Maybe they give them some stock in Nova, and they hold on to the royalty, and potentially it'll pay out in the future. So they're big development projects with very large, diversified mining companies that will eventually pay out here in the next few years. And then they'll just continue to get more. And as they ramp those things up, the royalty continues to grow with volume and price. So that's kind of how I look at it. So here's the copper inventories. They're nearing depletion here. The global copper cathode visible stocks. This is in thousands of tons, and these are your years. And what you notice is you've got 2016 and 2017. So 2016's here. We had an inventory build in 2017 and in 2018. So inventory build. And then in 2018, you can see this thing really start to roll over and go down, and we ended at 800. And remember, this is cyclical, in terms of weather. In terms of time of year, not weather. And then in 2019, the gray line, we started to come lower. In 2020, even lower. And then 2021, we are way down here. And I like how this depicts each year how the inventory is starting to get eaten up. Our inventories are dropping. And remember what I say all the time. I say this with housing and real estate. I say it with anything, in commodities as well. If you can see the inventory starting to deplete, even though the prices are going up, you're just going to continue to have the prices go up. You can't have inventories deplete completely. So when we get to critical levels, and I don't necessarily know if this is a critical level. I think we are getting to critical levels. This is going to rocket higher. It has to, because you have no inventory. It's happening in oil as well. And all these other, in uranium, oil, nickel, all these different commodities, they're being drawn down. And this is the interaction between the supply and demand. So if you're sucking out of inventory, demand is greater than your supply, and your supply is not keeping up. That is the resultant of inventories depleting. Here's another more information. The world is burning the most coal ever to keep the lights on. Coal-powered energy generation seen rising 9% this year, 2021. World's trajectory threatens 2050 net zero emissions goal. The world likely will generate more electricity from the dirtiest source this year than ever before, indicating just how far the energy transition still needs to run in the fight against climate change. Coal-fueled generation is set to jump 9% from last year, according to the IEA. IEA. That U-turn from the declines of the previous 2 years threatens the world's trajectory to reach net zero emissions by 2050. Looking over here, what we've got is the monthly Dutch TTF natural gas price versus crude oil. We've got this massive move in the dark blue, which is the natural gas price. It's up 500% in 1 year. Oil is slowly moving up, and what's happening is natural gas is getting so expensive, they're starting to substitute oil for it. and they're starting to substitute coal and whatever else they can burn. And that's why I have coal on here. And that's why I think oil is about to go vertical. So looking at this, we've got the net change in global oil production 2008 to 2019. This is SRS Rocco report, just to let you know where I got this from, versus the growth from the United States and Canada. The total global production increase, this is the production increase of Canadian oil production, US oil production, and the rest of the world. The rest of the world is declining. They're done. All of it, almost all of it, 85% of the increase came from the United States, and it was the 10.3 million barrels from shale oil. But shale's in decline now. And I don't know how they're going to make up worldwide where this new oil is going to come from. And we've got all this substitution coming from these other areas of natural gas prices going through the roof, and it's in multiple areas in Europe and also in China, where we're seeing higher and higher demand for oil because natural gas is going through the roof. They're also sucking down the coal at ever greater quantities, as seen here. So moving on down, this is the producer price index on a historical monthly chart. I like touching on this. This is the input costs for producers. It is rocketing higher. This and this and this will drive prices higher. Low inventories are going to drive copper prices higher. All of this is going to manifest itself in a higher PPI index. All of these commodities are about to launch, and your PPI is about to launch to the upside. And that's what we're seeing in all of these charts. Now, I'm going to touch on something here. It says the annual average gold and oil price change from 71 to 1980. 71 had $2.24 a barrel. 1980 was 36. It was a 16 times increase. Gold price, well, that was also 15 times. And you know what? This is more or less the increase in the money supply and the accounting for that money in the system. Someone asked me, and I'm going to jump back in here real quick. They said, where is the inflation? I said it went into stocks. When this goes and rotates back, and remember the charts that I usually put on there, the monetary base to gold ratio, that declines. Gold declines against that monetary base over time when the market conditions are favorable for other investments. Money gets drawn from those sectors. It gets drawn out of it and goes into stocks and bonds because that's where it wants to be. It wants to be in stocks. We're seeing the rotation of stocks in relationship to commodities start to turn. And that money is going to get sucked back into commodities. And what's going to happen is the money, like the 1970s I have here, is going to reaccount for the money. And what that means is all the money that was in the system that ran into stocks will come back over, and bonds, come back over into commodities and precious metals, and that metal is going to account for the money in the system. It's great. It is great if you're in those investments. And it's going to take time. I'm not saying this is just going to go vertical. We could go all over the place. We could even go lower from where we are today. It's going to be a transition. And the transition is slow. It's cumbersome. And we're going to get sticky when things start selling off and there's all this leverage in the system. It's going to be a messy transition. I can't say that I know what the transition looks like between stocks starting to come under pressure and commodities going up. They may both dive down and then commodity starts going up and outperforming quite dramatically. It's very difficult to know what that timing is. I don't know what it is. No one else knows what it is. So I just wanted to get that out. So I'm going to go into oil here. I got this from the Goreg. I can't even say the name of it. It starts with an R. They had an article, and it was a really good article, and I really wanted to share it with everybody on the channel here. It says, we thought extremely strong oil demand coupled with feeble rebound in non-OPEC production would lead to a situation never seen in 160 years of crude history. Demand would actually surpass global pumping capability by the end of 2022. That is insane. We've never seen this before. Even during the two energy crises of the 1970s, the Arab oil embargo in 73 and the Iranian hostage crisis of 79, crude demand did not come close to exceeding global pumping capability. Recent data strongly suggests our modeling was correct. Demand will exceed pumping capacity by the end of next year. That's 2022. And what we have here is investors need to recognize how interlocked energy markets have become. A crisis in one market is all but certain to spill over into another. European utilities are desperately switching from burning expensive natural gas to much less expensive crude oil, increasing demand by over 500,000 barrels a day. This additional source of demand has introduced even more tightness into the oil market that is already undersupplied. The oil crisis we had originally expected to emerge in fourth quarter of 2022 will not now likely come even sooner, as the natural gas shortage did. The coming oil crisis will seemingly come out of nowhere, taking much of the investment community by surprise. And what they call this is the S-curve. I know Kathy Wood loves the S-curve, but here's the S-curve. As a country gets richer, energy demand grows faster than economic activity for a period of time. We estimate that in 95, approximately 700 million people were in the midst of their S-curve. Today, there are almost 4 billion people in this category, the most in history. That is insane. It says incredibly large in an ironic twist. Institutional investors have little to no exposure in energy stocks. We know that by the ratio. The ratio tells us that. We would not be surprised if energy ended up representing investors' single largest exposure at some point before the decade is over. For all investors, we continue to recommend maximum exposure. I love that. I had to copy this. Now, these are snippets from the entire article. I'm just reading what I think are the most catching of the article. Our models originally suggested hydrocarbon reserve replacement will fall to only 40%. That means the reserves are only replacing 40% of what they're doing for production, while production itself will fall over 30% by 2030 unless capital spending trends move much higher. It now looks like a severe drop, and weak subsequent rebound in capital spending over the past 20 months is already pressuring oil and natural gas production. Super major production has now fallen over 10% since the beginning of 2019. A global natural gas shortage has already developed, and we believe this is only the beginning of a long period of structural deficit. And that's where prices are going to rocket. That's also why I'm in physical precious metals, because physical metals require energy to get out of the ground. And if we're entering a structural deficit, it means the cost curves of mining companies will structurally increase massively. So those that have metals in their hands will do very well, and those who are invested in energy directly. The world desperately needs the development of massive natural gas fields like these two to meet demand going forward, and it looks like they're getting a lot of resistance to put those fields into play from an emissions perspective, and there's super majors that are trying to put these large natural gas plays into production. It says Europe is on the precipice of a natural gas crisis, and we believe the US will follow soon. I completely agree with that. These guys are reading my mind. Natural gas inventories are 5% below normal in the US as we enter the withdrawal season. Production, meanwhile, is still 4% below its year-end 2019 level, and drilling activity remains subdued despite much higher prices. Prices could spike if North America experiences a colder than normal winter. Please read our natural gas section where we will discuss each. Now, we've gotten here, if the energy crisis has arrived, where does Gorig, and I can't say that name, Rosenschwag, see things 12 months from now? By the end of 2022, we believe global oil demand will have exceeded pumping capability for the first time in history. Just as no one agreed with our assessment of an emerging energy crisis this time last year, almost no one agrees with us today either. This is the contrarian viewpoint. Instead, conventional wisdom strongly believes OPEC's spare capacity will be returned, eventually throwing the market into a huge surplus in 2022. When we say demand will exceed pumping capability, what do we mean, and why is this so unprecedented? While it is true that demand has exceeded supply many times in the past, it has never, according to our models, exceeded pumping capability. What is the difference? Supply is the amount of crude produced and sold into the market. Pumping capability, on the other hand, is a more subjective term that refers to total supply that could, in principle, be produced quickly with minimal additional capital spending. Therefore, while demand has exceeded actual production, most recently in 2006 and 8, and in 2020, there has always been the availability of additional spare capacity. This will not be the case as soon as the end of next year. The consequences could be dire. Gasoline rationing, demand never actually exceeding pumping capability. OPEC production fell in 1973 in retaliation for the United States' involvement in the Yom Kippur War, and again in 1979 following the Iranian Revolution. Demand exceeded supply in both cases and prices spiked. However, pumping capability was unchanged. Production had been curtailed far below pumping capability. Our model estimates that pumping capability exceeded demand by nearly 5 million barrels a day following both the first and second oil crisis. And what I want you to get there, guys, what they are saying is that we've got a max pumping capability. They're saying the demand is going to exceed the pumping capability. We can't raise it up and meet it. Every time in history, we've had price spikes where we had dislocations in the market that were regional, not worldwide, where we would exceed capability in one area, but the world could always ante up and cover that gap. They're saying the world's at pumping capability, and we're going to exceed the world's pumping capability. There's no excess supply. I'm going to say this: prices are going to go ballistic. This will be ridiculous if this happens and if they're right. And even if they have it wrong by 1 year, doesn't matter. Doesn't matter. We're breaking the big long-term downtrends. We're breaking all this stuff. It is looking juicy, guys. More recently, oil markets were in a severe deficit between the summer of 2007 and 2008, caused primarily by disappointing non-OPEC production trends. Demand exceeded supply by approximately 500,000 barrels, causing inventories to fall and prices to surge from $55 to a record-setting $145 per barrel in 1.5 years. However, even the OPEC maintained over 3 million barrels a day per spare capacity, according to the IEA. 12 months ago, few people listened when we predicted an energy crisis was imminent. Now, our model suggests that we could be entering a new period in the history of oil, a period without an excess global pumping capability. The ramifications could be huge. Investors today have hardly any exposure to oil-producing companies at all. The ramifications could be huge. Investors today have hardly any exposure to oil-producing companies at all after having averaged 10 to 15% of the S&P 500 for decades and reaching a maximum of 30%. Energy stocks today stand at less than 3% of index. Just as few investors saw the energy crisis, fewer believe an oil crisis is looming. Position yourselves accordingly. And what I've got over here, I'm going to kind of zoom out and come onto the right here. What this is this is the super majors hydrocarbon production. We've been declining in production over time for the super majors. And the super majors, they don't produce, they produce 12.5 million barrels back here. Now they're producing 11 million barrels, and it's declining as their investments and their reserves become depleted over time. And for natural gas here, I said in the span of only 18 months, natural gas went from setting the lowest energy price on a BTU basis in 25 years to setting the highest price in history. That is a huge, huge statement that I don't think people understand here. In the span of 18 months, we went from the cheapest of natural gas prices on a BTU basis to the most expensive in history in 18 months. This past fall, Asian liquefied natural gas prices regularly exceeded $35 per MMBTU, equivalent to a crude price of $210 per barrel. While some extremely short-term weather disruptions may have led to historically higher prices temporarily, we believe $35 per MMBTU is the highest sustained energy price in history. It is now widely accepted that much of Europe and Asia is engulfed in this same crisis. So that's what I have for today. I wanted to share that with you. And my viewpoint here, guys, it's position. We know it's cheap. We've got great technical chart pattern setups. This stuff's coming. It's coming in front of us. This isn't the time to dilly-dally around and try to trade in and out and try to maximize a 10% profit. This is coming. Natural gas went from the lowest BTUs to the highest BTUs in 18 months. The crisis is out there. It's people are starting to substitute left and right for natural gas because we have a crisis in natural gas, and they're substituting coal, oil, and they're probably going to start flicking on uranium. If we have an energy crisis, I'm loading up in energy. I'm getting physical precious metals because if we can't get this stuff out of the ground, they're going vertical too. Physical metals. Now, if this is long sustaining, if this is going to have impacts that is far reaching, you can see very large patterns. We're talking 40-year patterns, and I'll go over it in another clip, of wheat, soybeans, of cocoa, of all these different commodities that were in a declining interest rate environment that are setting up these massive patterns. They're just absolutely massive. What do you think this energy crisis is going to do? It's going to set those patterns up. It's going to blow them up to the upside. So we're going to see increased food prices. We're going to see increased prices of everything. And if you look and you kind of just think this through a little bit, we've got a real estate boom, right? We're 5.2 million homes short. Lumber's going through the roof. If energy goes through the roof, if copper goes through the roof, if all of these inputs go through the roof, what do you think house prices are going to do? Go through the roof. And we're going to see an entire economy start to shift. They're going to start shifting to produce. More people are going to have to go into the energy sectors and start producing energy. So I do think that you're going to see a big shift here over the 5 to 10 years of that potentially happening. But I wanted to make sure that everybody kind of understands the gravity of what's coming. This is obviously a viewpoint from someone. Maybe it's delayed a little bit longer than what he has in terms of a time frame. I don't focus on the time frames. What I do is I focus on positioning, finding companies, and then putting money in it and waiting and sitting for this to materialize. Because this is a huge asymmetric bet. Huge. And when I was looking at the ratio back in the day, and I'll just give you a little bit of example of history so you guys can know what I look for in investments looking forward. I look at the ratios, and I had a gold to oil ratio. That oil blew out. Oil blew out to the downside. The ratio blew out to the upside. The ratio was 1 ounce of gold could buy over 100 barrels of oil. And what I said is, this is the biggest opportunity I've ever seen in my life. Why did I say that? Because I knew that, one, the ratio is blowing this out. You look at the actual dollar value of oil, which went to zero or negative for a very short period of time. They were going to cut back investing massively. And I knew that eventually the supply was going to decline. We had a crisis that was man-made, so to speak. Like we shut the economy down. That was decided by man to shut it down. Then we came back and ran it again. It wasn't like we had a crisis in loaning, or it wasn't a crisis from real estate. So I thought the demand was going to rocket back higher. So I put a lot of money into energy type companies, uranium, into oil. And I thought oil was going to have problems. This is the problems manifesting itself a year or two later, a couple years later after it, because of the investment cutback. And they were already cutting back on investment through ESG measures. I was looking at this like, this is the biggest opportunity I've ever seen in my life. And I was big in natural gas. I'm big into natural gas. I'm big into oil. And oil is going to have a premium because you can displace natural gas quite easily. You can run more coal. You can store energy a certain way. You can flick on nuclear power plants. You can kind of spread out that problem a little bit easier. Oil, there's no substitute to put gas in a car. So things I think will slow down. Sure, they can manufacture other things. This could put hydrogen economy in a hyperdrive. That's just going to blow your platinum investments up, right? And we're buying this stuff at the cheapest it's ever been. This is a huge opportunity for physical platinum, physical silver, because these things are going to get hit. When this hits, anything that's above ground is going to go far up in value. Commodities, in terms of commodities, oil is the number one commodity. Silver is the number two commodity. Those are like the ones you got to have, in my opinion, especially in physical format. If we're talking silver, platinum is used in the hydrogen economy and fuel cells, and that is what the current design is using. And they're trying to obviously use less platinum per fuel cell, and dope in other materials like copper and nickel and other things. And maybe they're successful, maybe they're not. But that's probably the easiest way to store energy is through electrolysis and creating hydrogen from maybe renewables or nuclear or something like that, and using that fuel to power something else. Maybe, we'll see. And maybe they can figure out a synthetic fuel, which is a mixture of hydrogen and something else that you can burn in your car today. Fingers crossed, I don't know. But that's kind of what I'm thinking is coming is an energy crisis. And I think it's going to hit oil, and I don't think there's too many good alternatives to substitute the oil. So prices, I think, will move on up. Plus, we've got the inflation. Plus, we've got the real estate investment or the real estate expansion phase in alignment with all of this. Everything's in alignment. So inflation's going up, guys. So that's what I think, and it's going to hit pretty hard next year. So I'm preparing for it. I'm positioning for it. I'm buying oil companies and all that stuff. And I know everybody just wants me to tell you the oil companies themselves. Maybe I'll do another clip on all that stuff. But go to my daily technical analysis. I go over a bunch of companies. Those are the companies I own. There are small to mid-cap companies that I own that can increase their production. And some of them still have hedges in place. They roll off by late 2022, a lot of them. So I think they're going to be well exposed for this move coming up in oil and natural gas. If you guys like this analysis, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.